quality stocks that have high probability of going up and rising in value. So I've named the strategy 1 weekly. The reason why I've named it that way is because it's based on the weekly chart. And the best thing about something like this is that if it's based on the weekly chart, you literally just have to check on the chart maybe at the end of every day. That's it. Maybe give it 5 minutes a day, nothing more. So let's dive right into our strategy. The first thing that this strategy has my key algorithm matrix that I've required, something called the CPM, which we will learn more about down the road, and ADV, which is the average daily volume, or what the volume has been over the past 60 days on average. And I'm looking for stocks with a minimum of 250,000 shares being traded on a daily basis for the last 60 days. So let's come to what we have here. We have the symbols, we have the price, we have the exchanges, we have the CPM. Our goal for the CPM is that it is above 2, because the CPM represents basically it's the common price multiple, which means that how many times does it double essentially within a year, because it's taking the average of the 52-week high and the 52-week low. We will go more into details in later sections. The latest float is a key matrix for finding high-powered stocks without any leverage. I mean, these are stocks that can literally move hundreds of percentage points within a week, if not a day. So the key is we're looking for latest floats, ideally below 50 million. And we're looking for average daily volume over 250,000. And I also look for volume that was on the last day of at least 250,000. Okay, so when we have this down, this is what the algorithm spit out or provided us with as scanned opportunities. The first one is key holdings. We can see that it's been since the beginning of 2016. The low that it hit was $3.91, and the highest it made in 1 year was $13.57. So it made almost $9 or over $9 in return, almost $10 in return. So 3 times its value this stock grew. And you can see this 1 week it grew over 53.2%. So these are the kind of stocks that I'm talking about that have the potential to move a lot, and that's what you're looking for with very low risk. So one way to take this stock would be, if you're looking to buy this stock, would be at the high of the last 2 candles, because these two candles represent 2 weeks. So the high of this is $12.03. I usually would put a buy stop just above it by 5 cents, so at $12.08, because that kind of gives me an indication that there's a breakout, and my stop would ideally be 5 cents below this. So my stop would be at $10.62, and my buy would be at $12.08. So I'm essentially risking $1.46 per share. But the potential for this stock is that it can easily go all the way, it can double within this year. There's a very high probability, because the highest it's been is over $23, and so yeah, it can easily double. And we're seeing that it's at a high of the last 52 weeks, or it's near a 52-week high, so it's in an uptrend, and that helps. Alright, let's come to another example. Similar thing that you can see, the low for this stock was $7.32, and the high that it made has been, wow, $29.45. This is all within a year. This is all within a year that this stock did. That's brilliant. And as we can see currently that it's near the high not too far away from it, instead of being down here. So it's in an uptrend essentially, or just more consolidating within this region. If I'm going to look to buy this stock, I would do the same thing. I would buy it at the high of the last 2 weeks, which is $26.98, and I would put my low below the low of the last 2 weeks, which would be $24.59. Now let's come to another stock. Here you go. Now this stock in January, let's just see what's the lowest it went to. I would say that essentially this is the lowest it hit. It was $3.95, and it went all the way up to $9.49. So made about, over $5.50, over 150% return on investment. Now this stock is kind of an ideal stock because if you look at its data, it's first got a low price, but then it's on the NASDAQ exchange. It has a cross multiple of 2.4. That means it has the potential to be a doubler in value within a year. Its float is below 50 million. Its average volume is over 378,000 or over 250,000. So there's liquidity in this stock. Now, how would I trade this stock? Well, I would actually take the stock at the high of this, which would be $6.95, and I would actually put it at the low at $6.10. So let's do some numbers. I personally like this stock, so I might actually be sending an alert for the stock to our students in just a few minutes. So we come to our video or our portfolio manager, and today's date is January 17, 2017. So MITK, and I am planning to buy this at the high of this, which is $6.90 plus 5 cents for spread, which is $6.95. So 6.95, and I plan on risking 6.15, I believe. Let me see. So $6.10 because the low was $6.15, so we make it 6.1. So then this sheet is telling me that the risk is 85 cents per share. The percentage is 12.23%. So that means that if I put all my money on just this stock, if it goes against me and if it stops out after triggering the stock at $6.95, I lose 12% of my account. Now obviously we're not going to be doing that. So let's continue. If the stock rises in value by 25%, which is essentially 2 times the return on investment, that would be at the price of $8.69. I can look at that as my first target stop. The second target stop could be when if the value of the stock rises by 50% in the coming months. So we have a stop at 610. We have a gain of 85 cents, and let's just say our account is worth $25,000. all right, if we have a $25,000 account, we would have to buy about 4,000 shares. Yeah, so P5 divided by D5. So okay, let me do something here. So the total amount divided by how many shares can we buy at the entry part. So we can buy up to 3,600 shares, and that would give our $25,000 account a risk of 12.23%. But if I have a $25,000 account, I want to keep my risk for my entire portfolio around 3 to 5%. So I'm not going to risk $25,000 on this trade. No. I'm probably going to be risking about, let's just say 5,000. So that means I may buy around 700 shares of this for approximately $600 risk on a $25,000 account. Personally, that's fine with me, because as you're seeing, there's not just one trade you'll be taking. You'll be taking dozens of trades. So it is quality trades that we have to take, and we don't have to risk too much money on one. That way we are able to run them in the long run and look for solid returns. So okay, that was MITK. I'll be sending an alert based on that. And let's move on to the next one. On deck, as you can see that there's potential for this one. You could buy it at the breakout of this, but to me, there is a trend and obviously it's kind of following the pattern of still being in a downtrend. It's kind of breaking the trend line. That's what I have the moving average for here, but I'm not too comfortable taking this one. This one looks like a good one, Cena Corp, but as you can see, the float is increasing in value, yet the CPM is still greater than 2, so there's still potential for this one to double. And just to see and look at things, we can see from 2016, and if you're looking at January 2016, right here, the low was $39.58 and the high was over $85. So it did double within a year, or essentially within 9 months. This one doubled, so there's potential. So I can look to buy at the breakout of 69.42 and put a stop at 66.35. So let's do that. Let's see how that works. Let's look at Cena at 69.42, and then I think, which is the high of this, plus 5 cents, and 66.35 right here. Okay, whoops. 66.35. So our risk is $3 a share, or our risk is 4% of our entire portfolio if we put all our money on this stock. And if it continues to rise, this is how it would look. If you're risking $5,000, you would be able to buy 72 shares for $220. These are the kind of trades you want to be looking for, ideally, that have low risk and potential to be doublers within a year. They can be very lucrative, because if you're risking 4% of your portfolio, or even 1%, and you take 10 of these kind of trades within a year, and if they are doubling, you're making a 20% return annually, and that happens quite too often with these kind of trades. Now, Cloud Peak is actually something that I'm really interested in, because first off, if you look from January low that was here, was $1.08, and the high that it hit in 2016 was $8.04, which is, as you can see, the CPM tells you, is 7 times the return on investment, or from the low. So it's huge how much this one has moved. It may have a slightly bigger float, but it has a lot of liquidity, so you can buy a nice chunk of shares for this. Now for me, I will personally be looking at a breakout of these last two candles again. So the high of this is 578 and this is 573, so I would buy at $5.83, and I would put my stop at $4.96. Alright, so this is Peak CLD, $5.83 and 4.96. That's 14%. Again, very high number of risk if we were just to put all our money on this one trade. So maybe I'll just take 5,000 shares, risking $750, which is 3% of my account value essentially. I am fine with that kind of a risk. I hope you guys are seeing the pattern on how a portfolio is built, that you don't put all your money on one trade. You may risk 2 to 3% of your entire account value on one trade. So yes, this is how these stocks work.